Hi, everyone. I'm Rick Bensignor. Today is Tuesday, July 5th. Welcome to this week's In the Know Trader show. What do we have on tap for the 30 minutes we're going to spend together? Well, in our trader education portion, I'm going to title it, If It Looks Like a Duck, and we'll get to that shortly on what I'm referring to. And this week, rather than doing a sector, I thought I would just go through some of the most widely held names on the street. These are in no particular order. These are not necessarily a current list of the most widely held. It's very hard to actually find that as a list at any given time, but certainly these are very widely held names. So good chance that you have several of these in your portfolio, and this way you get a chance to hear my thoughts on them. Before we get to that, let me tell you a little bit about my products at In the Know Trader. We have a weekly ETF Tactical Trader report that generally comes out Thursdays, gives you a very good background of things going on across the various markets. So we'll always take a look at the US 10-year, credit spreads, the dollar, often gold, oil, or some type of commodity. And then we really focus deeply into the S&P to make sure you know all the key levels and what I'm thinking about for the overall market. Then each week I give you a new ETF idea, which generally has a holding period of several weeks to months, but not long term. And then we finish it up by reviewing every open position we have until it gets closed out. So that's the weekly ETF report. Then once a month, I come out with what we call our 7-Eleven report. And this report, the goal is to outperform the S&P. And I've set this up to only have an investing universe of the 11 SPDR macro ETFs, such as XLK, XLE, XLP, XLF, etc., and be in no more than 7 of the 11 at any given time, with the goal of avoiding the underperforming sectors. And if you think about it, if you can stay away from the underperformers, you will outperform. And we have done so. In fact, here's the most recent statistics through June 30th. So first off, we have outperformed every single month this year. The total for 2022, halfway into the year, is we're outperforming the SPDRs by 310 basis points. That's rather significant. And of course, yes, it means we're down on the year, but the goal of this has nothing to do with making money no matter what. This is simply an S&P benchmark outperformance report. And we are handily doing that by outperforming the S&P by 310 basis points for our fiscal year, which starts every August 1st. So we are, 11 months into that one. We're outperforming by 405 basis points. And since we started this on August 1st, 2020, 23 months ago, I'm outperforming the S&P by 666 basis points. Now, if you put that into terms, if this was an actual actively managed fund, better said, is we would be in the top 10% of all actively managed funds out there that are benchmarked to the S&P 500. So it may not seem like a lot, but in the money management industry, to be up by 310 basis points halfway through the year and 666 basis points after almost 2 years, you are at the top of the field in money management. So if you have exposure to SPDRs or passive indexes like SPDRs, consider subscribing to this report. Once a month, we do minor tweaks on which sectors we're in and how much exposure we have in them. It's really simple to follow along for every one of your individual accounts that you would consider putting money into the S&P for. And it is very, very cost effective considering how low we price the product. Lastly, I want to tell you that shortly my time with StockCharts is going to come to an end. I'm going to be doing these videos on my own So I started my own YouTube channel under In the Know Trader. And here is a link to please sign up already to follow the channel. I've got some videos up there already. And again, very shortly, that is the only place you'll be able to find my videos each week will be at my own In the Know Trader YouTube channel. So you can see it's bit.ly/3ZUJZTO. And that is the link to follow. So write it down. That is the link to follow. Click on that and then follow my new YouTube channel, because if you like the shows that I do for you each week, that's where you're going to see them starting very soon. Let's take a look at S&P performance year to date in those 11 sectors. On the far left is the S&P itself through the spiders, down 19.14% year to date. So that would include, I guess, Friday, July 1st. And everything before then. So, of course, energy, the big outperformer, and it is getting hit hard today, as is oil. Oil's down almost $8 as we speak, at just over $100 a barrel. And so big change happening there. And that can, you know, if oil can get under 100 and stay under 100, that is potentially one of the headwinds that investors have had to face, being not necessarily eliminated, but certainly reduced as the price of oil and gasoline will come lower. And that certainly helps from some type of inflation point of view. Of course, inflation is still crazy and up near 8%, but if we can get gas down, that along with, of course, food, are the most important components that the government loves to remove when they talk about consumer prices minus food and energy. Those are the two things we care about most. But nonetheless, crude oil falling like this, and if crude oil closes beneath, I think it's 104.17 this week, and as I said, it's trading just above 100 early this week. That would break the chart to some degree and help things out. Consumer discretionary, communication services, and technology, the three worst sectors on the year, all down more than 25%. You've got four sectors pretty much in line with the S&P: industrials, materials, financials, and real estate. And then the other outperformers, but two are negative on the year: staples, healthcare, utilities has a small gain, and of course energy. Energy was up over 50% to the S&P this year. It's now only up 33%, and after today, it's going to be down even less than that, but still the big winner in the game. All right, let's just talk about this idea of if it looks like a duck. And what I'm referring to is, let's take a look at charts here and take a look at kind of a standard longer term uptrend. This is simply a daily chart of the cues going back in time. And you know, anybody who's just a simple technician knows higher highs and higher lows defines an uptrend, and we continue to do that until this period in early 2021, where the market went sideways for several months, actually broke down to new lows in March of last year. And that's really your first sign that, you know, you're in the midst of, or certainly potentially in the midst of, a trend change. Now, from the March lows, it goes and makes new highs into early April. Again, this is last year. But those new highs, if this was really good, they should have kind of held above the breakout point. And they only lasted there 2 weeks before pulling back down. And to me, that's your sign that this certainly could have been in transition, and the bullish trend that had been in place, let's go, I guess we'll say from the March 2020 low when COVID hit, was in question. And then this is, of course, let me bring this up to date. Let's see if I can fit it all in. Okay, so what I'm going to do is just pull in some more. So here's the picture since we made new highs that faltered and then came back against the old highs and faltered again. And certainly once you took out this low here, you've got no bullish trend to deal with anymore. You can't call it a bullish trend. So what acted like a bull, smelled like a bull, tasted like a bull, was no longer that. So if we want to say if it looked and walked and acted like a duck, and the duck was a bull market, that changed in the first quarter to early second quarter last year. And considering this is the picture since, you'd be hard pressed to not look at this in the exact same way, but inversely. This makes lower lows, lower highs, and continues to fade. And I bring this up simply, look, you know we're in the midst of a bear market. And forget what the press tells you. Forget this whole idea of 20%. You know, if you're 19.99% down from a high, for the press to tell you we're close to a bear market, but we're not in one, is just foolish. And this has acted like, looked like a bear market, acted like a bear market, continues to not be able to hold rallies. The only time you had some sense that maybe bulls had something going for themselves was earlier when we broke above here. But the fact that it faded and couldn't hold and breaks down again is just kind of taking a look at what's obvious. And without putting any models or indicators up here, we're simply looking at pure price action of a bar chart or a candle chart with no other indicators. It's very clear to see what's going on. And the reason I'm talking about this today is because I talk to some of you who I coach, and I get emails from, you know, in the No Trader clients, and the amount of hope that pervades and is stopping people from taking any type of defensive action. And defensive action is anything that reduces the risk on your portfolio. So if you're long and you sold nothing at all, then you're purely hoping that sometime down the road, prices will be well higher and you can do better than where the market is now. And if you're 20 years old, 30 years old, or maybe even 40 years old, I don't necessarily agree, but I can live with your decision. If you're older than that, especially 50s or 60s, and you've sold nothing, as you're getting closer to theoretical retirement age, or when you're not going to be collecting a paycheck anymore and that you have to live on your savings, then my question to you is, what are you waiting for? How much more down move do you need to see in order to get the sense that what used to be a bull market is no longer one? And that doesn't mean that I'm selling. Hold on one second. Let me make this into cues, easier to see instead of I had. Hold on. There we go. Better view. Sorry. So how much more do you need to see of, you know, kind of failure in price before you do something that's defensive? Defensive is lightening positions, selling calls against maybe things you have, buying some downside put protection. If you have access to and you know how to trade futures, shorting futures against some of the value of your portfolio so that you're not losing virtually, you know, all these, this rough 20% that the market's already off. And these are Qs, so Qs are off far more than what the S&P is off this year. So whether we look at this in terms of here spiders or, you know, Qs, it doesn't matter. These are very much bear markets. Now, the breakdown point here is where we came back to and stalled. last week or over the last 2 weeks, we filled one of the two gaps. You still have the gap in here in the S&Ps, but we filled this one and it's come off. You know, if it looks like a bear, acts like a bear, then it's probably a bear. And I'd say instead of hoping and praying that this comes back, which at some point in the future it will, the question is how much more downside risk do you want to take before you do anything that protects you from giving back all the gains that we've had. So on this year's low, we pretty much erased all of last year. So the, I don't know, what was it, 28% gain, something like that, you know, all disappeared. And remember, mathematics work differently than when counting up and counting down. When you lose 25% of the value of your portfolio, you need a 33% rally to get you back to where you originally were at the peak. So as we lose money now, and we're all losing money, we need an even stronger gain in the market over time to get back to where we were. So I don't want to go on much more about this other than when it is acting like it is and every rally is failing, staring, hoping, and praying that this comes back is not a good way to manage money. It doesn't show discipline, and it certainly leaves you open to potentially losing more as you simply watch and wait to see what happens in the market rather than taking some course of action. And I will tell you, for somebody who's doing this over 40 years professionally, doing nothing is far worse than doing something and being wrong. Because when you do nothing, you're like a deer in headlights. And when you do something, let's say you sold the absolute low of the year. Yeah, doesn't feel good. But at least you knew you did something in an attempt to improve your situation. Doing nothing is like leaving everything to other people to determine your fate. And that is not a position I ever want to be in. So that's what I have to say today about that. Let's take a look at these very widely held names. So I'm going to start with, here, I guess let's just use the same chart. I'm going to pull up Microsoft. And again, these are in no particular order. I'm going to put up some of the models I like to use now. So we'll put on cloud charts. We'll put on, let's say, a time to mark sequential count. We'll put on propulsion, ST levels. Let's see what we have here now. So this one, it's a bearish mode back in early 2022. For the first time on the rally, price broke beneath the cloud, lagging line broke beneath its cloud, and its lagging line has been underneath its cloud ever since. Rallies have stalled here. We just poked through the top of the cloud, but the lagging line didn't get through, so it never went back into bullish mode. We kind of double topped against the highs here in February and so on. Now we have cloud resistance just from a week ago. In fact, let's put this into weekly mode. What I like about this is it gives us a better perspective. And what we want to look out for now, given that Microsoft has basically held where it's needed to against this dotted line, just about $250 a share, is if we break through, we can get down, it depends on how many weeks it takes, but let's say somewhere around 243 is its break point. If we get beneath there, then the lagging line will have crossed through the bottom of its cloud, increasing the odds that we still have more to go. Notice the recent rally stop against the conversion line. When you have a strong rally, we tend to climb up the conversion line. Secondary support is at the baseline in orange. Right now, we had baseline high earlier in April. I'm sorry, conversion line high in end of May, conversion line high over the last couple of weeks. So first level resistance is stopping every rally here. So You've got to really, there's really not much to do now other than just watch and see whether or not we come through the bottom. If we do, we up the odds, then we get another leg down. If this holds in here and rallies, look for resistance up against the bottom of the cloud as we rally. If it happened very quickly, you're going to have the bottom of the cloud and the baseline kind of in the same place. So right now, resistance right around 280 to the low 280s. If it takes a month to go there, it's up at about 287 or so. So just watch that. Tesla, a downgrade. Same thing, lagging. This held exactly where it needed to, right against the TDST line on the 9 count, but same thing, can't get through its conversion line. When you have a bearish looking market and you can't get through conversion lines, first level of resistance, you have a fairly significant bear market. So until we at least get a couple of Friday closes above this pink line, you're still in bearish mode. So right now you're in trading range, but you have to be careful if this comes out through the bottom at 586. All right, you get more Friday closes under 586, the bigger the chance that these lows at 550 give way and you have a full leg down. Resistance looks very clear going forward for the next 6 months, right? It's in and around 890 to 900, and that's that. Meta, the former Facebook, horrible looking chart, continues to, well, we made new lows 2 weeks ago, haven't bounced much. Same, fairly, look, we're getting resistance here most of the time, really can't close above this pink line, and it continues to be first level resistance is showing the way. You break through these March 2020 lows down at, let's see, the lowest low was 137 and change, then your next level down is down at 123. So, you know, poor looking chart coming closer to, I mean, we can even, let's see, draw a trend line from here, see what we get, probably right near it. So we're actually, last week closed beneath it. We'll see if this can't hold, we continue falling. So not a good looking name. Hopefully one of these, if we look at, is something good. Google, notice bottom of the cloud, we broke through the cloud, bottom of the cloud has been resistance, same thing, lagging line, this is all consolidation. Bar 7 was the low of this 9 count, it's an imperfect bottom, so generally you make a lower low there. Starting in about 2 weeks, if we close under 2084, then that opens, on Friday closes, that opens the door for a further move down. And as far as strong support, I mean, you can do Fibonacci retracements and stuff, but to me, the next level I'd really rely on is 1896. Percentage-wise, a decent chunk down. Netflix. Netflix also, look, conversion line resistance here. It's trying to get a base, you know, it's been building a base since the low, somewhere around 175-ish, trying to hold on to it. But this is also potentially due for another, if the lows don't hold, next level down is 149. I think the low was 164-ish, 163-ish. And next level down would be 149. And beneath there, oh, wow, all the way down at 118. So another name that, now if this can muster a rally, it's got some good room on the upside. Hard to see what's going to do that right now, but it does have a fair amount of room to go. Amazon. Can't get out of its own way. He's still trying to build a base in here. Let me see if I put on an aggressive count. Let's see, did we? Okay, so we had a 13 downside exhaustion signal here on the lows. We got a good bounce of 20% or so, but it's faded very quickly, and we're on a standard 10 count towards the 13. Tough call here, but next level down of real significance is about 90.5. You need multiple Friday closes above 132 to have any chance that the bulls have a fighting chance on this. United Health, UNH, prior darling name, came back, pulled right to the cloud, bottomed on a set of 9 counts, come back. needs to, let's see, really needs multiple closes. Friday closes over 528 to increase the odds that this could make new highs, but it's still very questionable in here. If I didn't have a position on right now, I don't think right here and now I'd put one on. I'd be just waiting and watching. Broadcom, ticker AVGO, broke 3 weeks or 4 weeks ago underneath its cloud. Now you have some theoretical support from the lagging line at the top of the cloud all the way down to the bottom of the cloud. The only place that'd be safe for buying is down at 373.5. In a few weeks, we'll probably finish out at 9 counts. We'll have to see on this, but going forward, you've got all these trap buyers since fourth quarter last year. So look for resistance starting right near 550. ASML, this broke its cloud, lagging line broke the cloud, conversion line being resistance, pure sell mode. I'd look for this to go down to 377 to 361 next, potentially over the next month or so. What we have, Mastercard, ticker MA. So this has finally broken to its bullish structure. Now it still looks sideways, but you'll notice that price action and the lagging line are beneath its cloud for the first time in years. In fact, lots and lots of years, maybe since 2009. That's my signal that we're almost out of time here. So this is probably one of the strongest names we've seen, but even MasterCard is now structurally broken. If you're along this name, I'd lighten up. I'd sell some calls against position. This has certainly risked down to 288. And the last one we'll do is, we can get to all of them, but let's do Apple, because so many people have Apple. So set of 9 bottom happened the same time. Lagging line pretty much hit its cloud top. Bounce has not been able to get through its conversion line yet, so we still have resistance up near 142. Pay attention to that conversion line. If we can't get through it, then it's only a matter of time before this breaks. But this still structurally holds on to its bullish structure such that it has not turned into complete bearish structure. But price on the cloud's not great, but it's not the worst thing. That is it for this week. Again, sign up for my new YouTube channel. I'm Rick Bensignor, and this has been In the Know Trader.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.